Hey everyone, I appreciate you taking a few minutes out of your day to join me for a real brief presentation on the randomness of returns. And this is a subject that comes up a lot with us, and not only internally, but with clients as well, particularly starting out. But it kind of gives you a little bit of an insight into how we see things in the global markets, and a very high level overview of how we filter this data down to portfolios. So if we focus our attention on the chart here, which looks a little like a mess, I apologize, but it almost looks like a periodic table of returns here. It features an annual performance of major asset classes in the U.S., international, and emerging markets over the most recent 15-year period. The top chart ranks the annual returns from highest to lowest, and then using the colors that correspond to the asset classes. And you can see the names of the asset classes down here on the bottom, and that, of course, displays the annual performance of each of these asset classes. So, you'll notice that in both the U.S. and the non-U.S. markets, there's really no predictability in asset class performance from one year to the next. Really studying the annual data in the slide. And of course, we go back much further than this in our own analysis, but it really reveals no obvious pattern here in terms of returns that can be exploited for excess profits, or used to time when to get in or out of an asset class or market, let alone try that at the individual stock level. So this kind of gives you a little bit of an insight into kind of how we view the global markets and what we pay attention to. Now, I'll draw your attention to one particular asset class, just as an example. You could choose any one of these asset classes, and it's all very random. But this one in particular, I kind of chose to just highlight, the wild ride that the individual asset classes can take you on. And I'm going to trace real estate, and you'll see a little bit of a delayed drawing here. I apologize, but we'll take a look at kind of the journey that the real estate asset class has taken you on over the years, and it's been a great performing asset class. But trying to predict, when this sucker is going to outperform or underperform is just impossible. There, you can see here with the line, there's just no predictability here, no real pattern, and it's a pretty wild ride. So that's a good segue kind of into this next slide here. So if we take that information and we think about it at a model portfolio level, here we've got allocations that we put together. These are not our actual model portfolios at all, but very condensed, simplified versions just for illustration purposes. But you can see across the top here, we've got 5 models. And for each of the models, we are keeping 60% in the equity bucket, and 40% is static in the fixed income bucket or bonds. So across the board, essentially, you have a very broad overview of a 60-40 portfolio. Now, where it gets different is on the equity side. As we move to the right from model 1 through 5, you can see additional diversification in the equity universe. And you can see that built out here. So if we take this information and then we look at it under a microscope in terms of model portfolio historical returns, we can see in this chart, the upper chart ranks the year-to-year returns from highest to lowest of model portfolios 1 through 5, and the lower chart features historical annual performance of the model portfolios over the most recent 15-year period. And we have a far right column here of actual annualized returns of those model portfolios over the 15-year period. And so it's nice to see, and you can see here that as we've increased the diversification in the model portfolios, we've actually enhanced our return over that time period. And so if we focus kind of back up here on this chart, this looks very similar to the asset class returns chart that we first looked at. And while the asset class returns are, can vary very considerably from year to year, very wild swings, by combining the multiple asset classes and areas of the market, we can really help to reduce the volatility associated with this random behavior. And so, although there's definitely some randomness in here, you can see that the bands are really tightened up here between the model portfolios in any particular year. So, the global diversification really helps us to reduce the effect of a single asset class or a market on performance. And really this helps us become better planners. We can really help to plan our clients' futures better by really narrowing down the expected rates of returns of our portfolios and really becoming familiar with that. And so, returns are never predictable, but this does help us to construct our model, our allocations for our clients, and have a better idea of what to expect going forward. So again, I hope you found this somewhat helpful, and it's just a kind of a 30,000-foot view of how we start to think about the global markets and filter that information down to our portfolio construction. So again, guys, I really appreciate your time. Thanks so much. And as always, if you have any questions about anything, give us a call. And hope you guys are having a great day, and hope to hear from you soon. Thanks.